Hey guys, this is Casey and welcome back to the channel. So if you've been following the stock market recently, you see that the stock market has rebounded tremendously since the Federal Reserve has stepped in the past few months and helped support the stock market. Stocks seem to be at an all-time high. Apple, Tesla, many stocks. And right now I want to talk to you guys about 10 reasons why I think we are going to have another stock market crash and what you can do about it. So thanks for tuning in. Hey guys, this is Casey and welcome back to the channel. So today I have 10 reasons why I think a second stock market crash is coming and what you guys can do to protect your investments. So let's just jump into this. So the number one thing that I think that the number one thing reason I think that we're going to have a recession is because of the COVID-19 knowledge. So right now everything is still kind of evolving with the COVID-19 outbreak, with the vaccinations. There just seems to be a never-ending news story cycle of what's going to entail with the virus and how deadly it is, how easily it is transmissible. Also with the vaccinations, how closely we are to a vaccination, is it going to work? And there's just so much conflicting information to where there's a continual amount of uncertainty in the stock market that, who just knows that at the slightest wind of something really fearful additionally kicking in, the stock market could crash again. So until we get some kind of definitive answers with this vaccination, or until this virus begins to die down because we're doing the proper protocols that the government is recommending with the mask and with the 6 feet distance and so forth, until we get that under control, there's a lot of variables with the stock market. So that's one of the main reasons why I think that we are going to potentially have a crash. The second thing kind of still goes back to the whole COVID-19 again, is that everything in the news says that we're going to have a second wave. Now, we don't know if that's going to coincide with the winter time, with the fall time. We don't know if it's going to, heaven forbid, that it's going to significantly multiply, duplicate, and get even more deadly. And no, we just flat out don't know. But we do know that it is going to be a second wave at some point in a period in the time. And obviously some countries are going to do better at it, protecting themselves than others. But we know that it's coming. It's just a matter of when. And because everything in the news says that the virus has replicated very fast, and that it's a single strand of its DNA, so it replicates even faster than normal. Just all sorts of things. Kind of tells us that that it is very possible that if we do have a second wave of infection in the fall or in the winter time, if it is, heaven forbid, if it is worse than the first phase, or I should say the first wave, then that's obviously going to have a significant draw on the market, probably even worse than the first pullback. So that's a really big reason why I think that we're going to have a potential second crash. In addition to that, the infection rates in our current wave continue to go up. So as of right now, I live in the state of Texas, and the infection rates are at an all-time high. We're getting people infected even more so now than we did when we initially closed. So that's a really, really important thing to take into consideration. And a lot of other states are also encountering this: Florida, California, and so forth. So the first two things are the reasons. The first two reasons are specifically COVID related and the vaccinations. And then the third thing I think is the business activity. I think it is going to be very slow to bounce back. So the reopening of the U.S. economy, I think, was going very well up until a few weeks ago, from what we heard, or at least until at least that's what our the president stated. But we still have a record 17.7 increase. Although we have a record 17.7 increase in the May retail sales, many retail categories have been dealt a significant blow to their revenues. So much so to where they've had a slump between 20 and 60% over the past 4 months. I mean, the simple fact that the U.S. still has actually now 43 million people unemployed. I mean, this is just absolutely bonkers, right? I found it very weird and very odd that the stock market is so disconnected right now relative to where we are, because if you really look at everything from a face value standpoint, we should be in we are technically in a recession, but the stock market should be reflecting that right now, and it just flat out isn't. It's damn near at all-time highs with a lot of the major tech stocks, and it just makes absolutely no sense. So you look at the retail sales; they're down significantly. Pretty much all purchasing power, right? So the consumer purchasing power is like 65-70% of the stock market, 65-70% of our economy, excuse me, and that's down significantly across the board. And yet we have stocks at all-time highs. And that's just purely because the Federal Reserve stepped in and said, we're going to put the cheat code into the video game, and you guys can just play Madden on 99 players across the board. But that's great, but at some point in time that's going to give in. The Federal Reserve, the government can't support the economy entirely and indefinitely when we have so many things outstanding with the coronavirus, with unemployment, with waiting on the second stimulus package that I do think that we are going to receive. At this point, it's just a flat out foregone conclusion. I think that it's coming. But even after we receive that and we get the stimulus check, what does that mean? What do we do in terms of getting 40 million plus people who are still unemployed being provided by the government back into work? How do we do that transition? How do we manage that with the potential COVID-19 outbreak? Heaven forbid it's even worse. There's just so many factors right now. Not to mention we haven't even gotten into the earnings things yet with the second and third quarter of the companies. So that's a really, really, really big thing. Which leads me to my fourth thing, which is the stimulus funding. So I've touched on a lot of my videos in the past where I've told you guys, at this point, I think it's almost a foregone conclusion. We are going to get a second stimulus package. I think that's just a given. It's not technically a given yet, but it's a given. I mean, the president's already stated it. The Republicans have stated it, who were the last stalwarts to kind of hold out. They were ready as of July 3rd to get something done. The Congress is on recess until the 17th of this month, and then I think we're going to probably hear about getting something done. If not before, then certainly a little bit after that. But after that, where do we go from here? So they're going to pass a second stimulus package. We're going to probably get an additional stimulus check. They're going to probably extend the unemployment benefits out to probably July of next year, and then they'll probably put in some kind of addendum that says as states' unemployment rates begin to lower, depending on the kind of state that you're in, if it gets below like 6% unemployment, then they'll begin to phase out or completely eliminate the unemployment benefits, which makes sense. But that still doesn't give us a very clear outline on how we're going to transition everyone back into the workforce. Typically if you have a 3.5-4% unemployment rate, that's not bad. Right now, we're significantly way higher than that. We are at literally recession rates. So at some point in time, we are going to have to get some kind of transition, but you can't really do that when we don't know what the heck's going on with this virus. Which leads me to my fifth thing, which is as I already touched on, was the earnings, right? So with stock markets and with stocks and with investors that really move the stock market and stocks up and down, they look at a lot of earnings. They look at a lot of earnings per share, and they look at the forward earnings. So they're looking at the projecting of sales and revenue for the second and third quarter, and a lot of the companies have put their guidance. So a lot of the companies said, "Listen, stuff's going to be awful. We're not even going to pretend like." They basically said things are going to be so bad that we're not going to maintain our guidance, and then just have you guys see that we significantly didn't hit that. So we're just going to pull them. So everything that we told you we were going to make and sell, just completely scratch it, tear the paper up, throw it in the trash. We have no guidance. And normally when that happens, investors get spooked, right? I mean, these large investors and even small investors such as myself, you hear about a company tearing up their guidance. I mean, that they're telling you point blank, our stocks are going to fall. Our revenue is going to fall. Our earnings are going to fall. It just, it's a foregone conclusion. And what happens? For example, Facebook came out and said, "Yeah, our first quarter was awful, and by the way, our second quarter is going to be awful." And the stock goes up like 5% the next day. I mean, it's just everything is just so backwards. And so there's going to be a recalibration period that kicks in, and that may probably coincide with the second outbreak, with the second quarter or third quarter. Who knows? But I do think that's going to play a huge factor. At some point, stocks just can't continue to keep going up like this when no one's spending money, everyone's unemployed, being supported by the government, and we have basically just basically the economy still at a standstill. Which brings me to my sixth thing. As I already touched on, so I'll just kind of consolidate this with the other one, is the quarter 3 and quarter 2 earnings, right? I mean, you just can't with no earnings. Estimates, how can you properly gauge a stock? How can you gauge the healthiness of a stock? You can't. And like I said, normally 98% of the time when a company pulls guidance, such as a lot of the big companies have, tech companies included, they're not at all-time highs. This is bananas. And the reason that the stocks are at all-time highs is because of the Fed intervention, the purchasing of the ETFs, the purchasing of the bonds. I read just last week, actually, that the Federal Reserve is purchasing bonds of major companies, even companies that aren't in financial dire, such as Microsoft and Apple. So when you think about Apple, I mean, Apple has more money in cash, not just their valuation, not just their total revenue, cash, liquid money sitting in the bank. They have more cash than the GDP of most countries throughout the world. And you know what? The Federal Reserve said, we're going to go ahead and buy your bonds too, which basically means that there's some IOUs, that the federal government gave Apple some additional money to sustain, which is just, it doesn't make any sense. And so, it's going to happen. It's going to have a pullback. We just don't exactly know when. Which takes me to my next step, the number 7. A huge part of why the stocks have been going up, even pre. Now, again, most of this is pre COVID-19, which occurred in October of last month, at least from the China period. A really big reason is the share buybacks. So one of the things that companies do a lot of times to prop up their stock valuations or to buy back their own shares. It's a really cheap way to lower the amount of shares that are in the market publicly, because when a company buys back their shares, there's less number of shares floating around for people to exchange, and so then that automatically raises up the price of the stock. And Apple did the largest amount of buybacks that they've ever done in 2019. And that's why the stocks just continue to go up. And then we had the COVID thing, and then we had the government step in and give them more money. And so I think that the share buybacks are going to pretty much stop for the most part, or at least slow down significantly. If you look at the airline companies and you look at the cruise line companies, they've stopped their share buybacks. So that can't prop up their earnings per share. The stock valuations could be tossed under the microscope, and that's just going to be a foregone conclusion, I think. So is the buybacks has been a really big thing that stocks have done, the companies have done to their stocks, and I think that's gonna stop. Number 8 is the mortgage loan defaults. I think they're going to rise. You never ever want to hear about something like this because it's already hard enough as it is to get qualified for a mortgage. Excuse me, it's difficult to get the financing lined up. It's difficult to have the savings amount, the savings that you need to have, and then you just work hard and you go through a lot to get your home and to make it your home. And so it's kind of sad to think that people are going to have a larger increase in the mortgage defaults. And I think it's just a natural occurrence that usually happens in a recession. Luckily, we have a government who has done a lot to ensure that that gets minimized. Even though we have 21 million people out of work as of right now, graciously, because of the government, the majority of them have been able to pay their mortgages and the rent because of the unemployment amount. So much so to where I've even heard that a lot of people who are unemployed are actually making more money unemployed than even when they were working. And so with that, I think that we are going to see an increase in loan defaults and mortgages as the government begins to phase out the unemployment amount. Whether that takes place, well, I guess it's going to have to take place in the second stimulus package, but I do think that's going to continue to incur. And as that happens, the rates are going to just go up. It's just natural that occurs. So, it's just going to be a given on that. One important thing to also keep in mind as well is that the delinquency rates have already started to go up even with the stimulus amount. So much so that a survey from apartmentlist.com found that 30% of Americans have already missed their housing payment for the month of June. That's a little concerning because the economy has been supported by the government in unemployment amount. With the unemployment benefits, and so the fact that that has continued to go up, that's concerning. So 30% of Americans have missed their housing payments in the month of June. Which leads me to my number 9 thing, auto loan delinquencies. So auto loan delinquencies is one of these sneaky dark horse things to where auto loan delinquencies have continually been going up year over year over year, and it was at a very, very concerning rate in the beginning of 2019, which was well over a year ago. So much so to where before this COVID-19 thing broke out, I was actually going to make a video about how I thought that the auto loan delinquencies was going to be the main predicator that caused the next recession. Well, now not only do we have the COVID-19, and not only do we have the increase in the mortgage delinquencies, but now we have the auto loan delinquencies. So again, they were already rising well before the pandemic. But as recent as the third quarter of 2019, 2.5% of borrowers with indirect auto loans were at least 30 days overdue on their payments. That doesn't even account for the 60 and 90 days and so forth. And then, following the quarter one of 2020, the median amount of delinquency loans tied to tied to autos among large banks and lenders, it actually stood at 7.5%. So that's just it's a very very large amount. Again, this is still all supported by the government with the funding on a monthly basis, and so I do foresee the loan delinquencies also going up as well. Which also I want to kind of do an addendum in this. Guys, I did a video a while back that didn't get a lot of views, but it was one of my most proud videos that talked about why car loans are one of the number one biggest wealth killers. And it's because in America, we like to show how much money we have or don't have through our cars. We don't actually look at the lost income, excuse me, or I should say the lost benefit and lost growth of our net worth by purchasing very expensive, easy to break down, high maintenance type vehicles, and just how much that adds up over time. So if you guys haven't already, please make sure that you check out that video, because it's very important that you guys take a look and just understand why cars can be such a big wealth killer. And then the number 10 thing is the Federal Reserve has really used a lot of the traditional firepower to kind of help sustain the economy in this COVID-19 situation. So, on average, the recession, every recession has been met with the Fed reducing the federal funds rate. And the federal funds rate, for you all who aren't familiar with that, is the rate that the banks charge each other. It's kind of like the prime rate that the banks charge each other to borrow money from each other. So you guys may not know this, but banks borrow money from each other. It's actually one of the main ways that they make money. And that then affects the rates that we receive from banks when we go to borrow. And usually that's one of the main things that the government does during a recession period, is to lower the Fed's fund rate, so that it lowers interest rates, so that it encourages people to want to borrow. And so that's pretty much already been lowered to the point to where we're now discussing having negative interest rates. And so, the Federal Reserve can't lower rates any lower than what they are now. And so, that's one of their main tools to help during a recession. And they pretty much have already exhausted that for the most part, outside of going to negative rates. The Federal Reserve does have something called quantitative easing, which is another tool in their arsenal. But outside of that, the quantitative easing hasn't proven to be as reliable and as definitive as the federal funds rate. So what does all this mean, right? So I've given you guys all these theories and things that I think that's going to cause another recession. Well, what this means is really a couple of things. One, it means that you need to prepare for this. So if you guys are working, make sure that you're saving, right? Make sure that you're preparing for a rainy day. Obviously, right now, no one's really eating out. You're not spending a lot of money eating out on food. No one's taking real vacations. No one is probably making any large expensive purchases with cars. At least I hope you're not. And so, you just want to make sure that, number one, you're saving as much money as you possibly can. The second thing I think of is that, when it comes to this type of thing, is you just need to make sure that you're ready and prepared for when the stock market crashes. So I uploaded a video a while back, as in last month. It might even been the month before that. I have to go back and check. A video to where I put a clip in with Dave Ramsey, to where he said that he made so much money during the recession. And the unfortunate thing is, but it's it's a byproduct of recessions, is that people really make a lot of money in recessions when you're prepared. Right now, Apple's at all-time highs, Tesla's at all-time highs, Microsoft is at ridiculous rates, evaluations. And so during recessions, these stocks pull back. And they pull back not because of something that they're doing from bad management, and not because of they're not able to manage their business. It just pulls back because the economy as a whole is in a slump. And that's when smart investors, small, medium, and large, step in and buy these companies at these very low valuations. And then 6 months, a year later from now, they've doubled their money, or they've gotten 50%, returns. So, if you guys are looking to make a lot of money in the stock market, You know, it doesn't hurt to put a little bit of your money in now, but make sure that you leave a good healthy 30, 40, 50%, if not more, on the sidelines waiting for that next pullback on the stock market. That's pretty much it, guys. So these are my 10 theories as to why I think we're going to have a second stock market crash. I'm going to actually give you guys a bonus 11th bonus. Well, I should say an 11th reason based on why I think we're going to have a crash. And that's that on average, the stock market bull run lasts about 8 to 9 years. Well, right now we're on year 11. And so we should have had a stock market crash probably 2, 3 years ago. We didn't. And so here we are, year 11, and damn near going into year 12, and we still haven't had a real stock market crash. I mean, we had a significant pullback, 30%, and then it just got bought all the way back up. And so we haven't had a real recession yet, although they are saying, the news does say that we are technically in a recession. But, from a stock market standpoint, I can't tell. So, guys, listen, I really appreciate you all watching the video. If you've gotten to the end, then you guys obviously like the content, and I can't thank you enough for the support and watching. So I do highly recommend that you guys subscribe to the channel. If you take a look at the history of the channel and the videos that we talk about here, it is all financial education and news, and that's what we're about. We're about keeping you guys up to date on the latest news, the latest information that can help you on a day-to-day basis, and also things that just kind of help you guys overall with your daily lives, with your investing, with your savings, with the best credit card rates and brokerage accounts, and just anything that can just really help add value to you guys. So I thank you so much for watching the video, and subscribe, and make sure you tune in to watch the next one. All right, take care.